Welcome to the Prime Property Finance Podcast with Gareth Morgan and Mark Watts. This unique podcast will dive deep into all areas of property investing finance, going behind the scenes with property professionals, investors and clients. Between us, we have 35 plus years experience in property finance. The podcast has been launched to share knowledge, mindset requirements and experiences of successful investors and professionals. We aim to simplify many of the complicated areas of finance and investing and provide valuable and easy to implement tips. Keep an eye out for our new longer episodes every Tuesday and our shorter ones every Friday.
Hello and welcome to today's episode of the Prime Property Finance Podcast. My name is Mark and in today's episode we'll be looking at security, specifically security in property investing. Now, it's a topic we discuss a lot with clients. It's something that we think people should really understand whenever you're stepping into a bridging, development, mortgage, or borrowing of that nature. And a topic that can get complicated, but we're going to keep it super simple. So with that being said, let's get straight into it. So security in mortgages, as you may well know, or everybody will understand that when you take a mortgage, it's secured lending. So that means that you offer the property that you're borrowing against as security to the lender. Now, there are different types of security that the lender can actually take, and we'll just run through them in order. So the most common one is what we would refer to as a first charge. What that basically means is that the first charge holder or the mortgage lender subsequently has first claim to that property in the event that you can't keep up repayments on your loan. Okay, so if you were to default and the position got to a juncture that the lender called in the loan or wanted their loan repaid and you couldn't repay it, they would then have the right to sell the property and then use the proceeds of that sale to clear off any mortgage that's there. Okay, it is the lowest form of risk for a lender because there is nobody else involved in this conversation. It's just you and the lender, and they have first charge. So they can force the sale, sell it, and that theoretically will cover the outstanding balance. And that is why we have loan to values. So that's why there's always equity in the transaction to make sure there is sufficient room that if something went wrong, that the lender can recover the proceeds of their loan. First charge lending is also the cheapest that you will have because the risk is the lowest. Okay, and you'll see this on your home with your residential mortgage. It'll always be a first charge, as to with bridging, predominantly with bridging, certainly with buy-to-let, commercial mortgages. So your longer term lenders will be looking for a first charge. Then we come on to the second charge. Okay, so as the name suggests, these are second in line. So these will sit behind the first charge holder. Okay, and there will still be an upper limit as to what you can borrow on a second charge. Again, the property value needs to exceed the borrowing by a certain percentage. Okay, again, we refer back to the loan to value. But a second charge, as said, sits behind the first charge, therefore represents a higher risk to the second charge lender. This can sometimes be a different lender that will sit behind the first charge. Okay, this could possibly be bridging finance. This could be if you've done some debt consolidation and you couldn't do it with your primary lender for fear of disturbing the rate, that sort of thing. So that lender will sit second. Again, what that means is if you should default any of the two loans in this instance now, because you've got a first charge and a second charge, then the property would get sold. The first charge lender will get their money first, then whatever's left will go towards the second charge. And then lastly, if there's anything left, you'll get the difference back. Okay. The risk here for the second charge lender is the margin for error or the margin to realize for the sale of the property is a lot smaller. Therefore, there is a risk that they aren't going to get all of their money back. Therefore, they increase the interest rate to cover that perceived or potential risk. Okay, so that's first charge, second charge. You can go to third charge, fourth charge, fifth charge, etc. Obviously, there gets a point where the property value gets exhausted. So that's something to bear in mind. We rarely see third charges, never seen a fourth charge. Okay, but theoretically, it's plausible. It's possible. Then we move on to something called the restriction on title. Now, this can be something which is really quite popular for bridging finance. We don't see it in mortgages. We sometimes see this in development finance. And what this is basically is it's not a charge per se, a charge on security. It's a restriction registered or an interest registered at land registry. So that means that you cannot sell the property without them being notified. So it isn't as strong as a first charge, certainly, not as strong as a second charge. So it's quite weak in that sense. However, there are lenders that are happy to lend on that basis. So we will sometimes use a restriction on title, for example, if we can't get consent of the first charge lender to allow us to come in as a second charge. Okay, and we'll use a restriction because we don't need that consent because it isn't, as I say, a physical charge on the property. Okay. One thing that I want to highlight as well, which I just touched upon, was when you put a second charge mortgage in place, you do need the consent of the first charge holders. So not all first charge holders will give you the permission to put the second charge in place. That's something to bear in mind as well. Okay, and a restriction on title is also a mechanism we can use to try and circumvent that issue. Now, moving into limited companies, it's becoming more and more popular to borrow or have mortgages, buy-to-let properties within limited companies. So it's equally important that we understand the security that exists when you do look to borrow within a limited company. Now, first charge, second charge, restriction on titles still happen in a limited company as well as in your personal name. So that structure doesn't change in any way. However, within a limited company, there are some additional pieces of security that you need to be aware of. Firstly, one which no doubt people have heard of is a personal guarantee. So a limited company, by its very being, is to limit your liability. Therefore, as company directors and shareholders, you ring fence that liability. That's why limited companies are the way they are. However, years and years and years ago, lenders obviously got stung because they would borrow money within limited companies, and then they would just dissolve it, and then they would be left without having their debt repaid. So what lenders have done since that, or to mitigate that risk, is to introduce personal guarantees. And what that does is actually tie you as the directors back to the company. So if the property was to go into default and they had to exercise their first charge, for example, on a mortgage, however, that first charge did not pay off the actual outstanding loan. Sometimes they will sell it. It goes into auction. It might not achieve its perceived value, and therefore there's a shortfall. Then the lenders will look to the directors under the personal guarantee to pay back the shortfall out of their personal monies, hence personal guarantee. There are different types of personal guarantees that you can have. So you can have individual guarantees. Okay, so that's Director A and Director B. They might have a guarantee which is limited, let's say to £100,000 each. That means that if Director B hasn't got the money and Director A has, they'll only recover the 100,000. And then the most common one, which you'll see, is the guarantee it's called a joint and several guarantee. What that basically means is if you've got Director A and Director B, it means that irrespective of which one has the means, they can come for the director and have all of the loan paid off one director, even if the other one hasn't got the money. Okay, it's the most secure type of personal guarantee that you'll see, and the most common that's used in mortgages. Now, the other thing that you may come across is something called a debenture. I'd say less common, but it does arrive certainly in commercial. It is definitely there in development finance, very common in bridging finance. Okay, and a debenture is effectively a company guarantee, for want of a better word. Okay, so it's known as a fixed and floating charge. So its security the charge covers all the fixed assets that exist in a company. So if you've got a property-only company, it'll cover all of the fixed assets. And the floating charge refers to things like the cash in a bank account. That's a constantly moving figure, and therefore that is the floating element. That only crystallizes if the company fails, and as such, they can recover the money that's in the bank account as well as other intangible assets that may exist. So a debenture in mortgage terms can be problematic. Why is that? Well, if you think that, let's say you borrow from Aldermore, for example, I just pick on a name, You borrow from Aldermore and you've given Aldermore a debenture. Now, they have security over the whole company. Therefore, when you borrow from Foundation Home Loans, for example, then this fixed and floating charge covers everything. Now, there will be a first charge, don't get me wrong, with Foundation Home Loans, but a debenture, as the fixed and floating on the company, can muddy the water. So you just want to be careful with debentures that some lenders do insist on them. You can't have more than one debenture. Well, you can, but it has to be done in a deed of priority, so they will sit side by side. And then there is a bit of a rigmarole about arguing who goes first, second, and the wording in that debenture. So you want to avoid that wherever possible. But it's something to be aware of. So this is the reason that we would often encourage people who are doing developments and have a portfolio of properties, that you would actually separate those two entities. So you do developing in one entity and you would do your longer term property investing in another entity. Debentures are more widely used, as I said, in bridging and development finance, and you kind of don't want to mess that up with the longer term stuff that you're doing on your property portfolio. As I say, because it just can make things a little more convoluted and difficult. So something to bear in mind there on that front. And that pretty much is the sort of security. We can go into all sorts of other types of security, but these are the most common ones that you will come across in property. Limited companies, please bear in mind that there are personal guarantees. They are common. They're standard with most lenders now. So you will be expected to sign a personal guarantee. You will also be expected to be seeking independent legal advice when signing this guarantee. So that's something to bear in mind. There's a cost associated to that as well. Okay, and it's one of the reasons a lot of mortgages slow down, because it can take a little while to get interest listed to get the advice on the personal guarantee. But it's something that will have to happen as well. So limited companies, additional security, which effectively ties the directors back to the company. And then you've got mortgage security, which, as I said, is first charge, second charge. You can go third, fourth, fifth. Extremely rare to go beyond anything past third, really. And you've also got this restriction on title, which can be a useful tool. However, the security gets weaker the further down the first, second, third that you get, meaning the cost of those funds are ultimately going to go up because the risk is greater. Okay, so there we have it. There's a whistle-stop tour of security, how it works in property and limited companies. Hopefully you found that useful. And if you've got any questions at all, you know where to find us. Our details are in the show notes. And yeah, look forward to speaking to you on the next one. Cheers, guys. Take care.
Thank you so much for listening to our podcast. We hope you have learned something and have some tips to take away. We'd be very grateful if you enjoyed the show. You could give us a review and share with anyone that you know that may be interested. And of course, subscribe to the show so you can get notified when a new episode is released. If you'd like us to answer any questions or go deeper on a specific topic, please drop us a message at primeproperty.finance. See you on the next episode.